My name is Rob Angel from TPD Wealth Management, and I'm one of the directors and advisors within the company. So we've got the tax year end fast approaching us. Tax year end, for those who don't know, is the 5th of April. And what I want to do this afternoon is just run through one or two common mistakes that people often make and forget. And it's particularly important this year as we move into a new tax year where people generally are going to have to pay more tax as a consequence of the budget in the autumn. So the first mistake to avoid is, if possible, maximise your ISA allowances. Everybody's allowed to invest £20,000 in an ISA each tax year, but if you don't use it all, then it's lost and you're not able to carry it forwards into the new tax year. So wherever possible, use your ISA allowance. So a tip here is to make a lump sum payment before the 5th of April. Ideally, it has to be done a week or so beforehand, because a lot of the ISA companies are going to be inundated this time of year, so you don't want to miss the boat. And then into the next tax year, rather than being in a situation where you have to make a lump sum or lose the ISA allowance completely, why don't you set up regular monthly contributions? Another mistake people often make is to underuse their pension contributions. Now, everybody's allowed to make up to £60,000 a year in contributions, or up to 100% of their earnings. And the great benefit of pensions is they're incredibly tax efficient. Now, there is a bit of a get out here in that if you can't maximise this year's contribution, you can carry it forwards into next year and carry forwards the previous 3 years. But it's a really good way to reduce the amount of income tax that you pay. So please, wherever possible, don't forget to do it. Another mistake people often make is to not use their capital gains tax allowance. Now, everybody's able to make a capital gain of up to £3,000 in a tax year. And particularly for people where they have large share portfolios or other investments where they can have capital gains tax liabilities, if you can use this £3,000 capital gains tax allowance, it's going to save you money in the long run. A top tip here is to use your spouse's capital gains tax allowance as well. So if you do have shares that you want to sell, why don't you transfer some to their name as well? There's no interspouse capital gains tax liability, so by transferring to them and they sell, then you're doubling up your capital gains tax allowance to £6,000. Another mistake people make is to not use their inheritance tax annual gift allowance. Now, everybody's able to gift up to £3,000 in a year without it forming part of their taxable estate, and you can use last year's if you haven't already used it. So between a husband and wife, this can amount to up to £12,000 this year. And with inheritance tax looking as though it's becoming more and more of a target for taxation, it's a really good area for people to look at. And the final mistake people often make is leaving things to the last minute. Please don't do this. Please give yourself a little bit of time to put all these things into action, as it can mean that you miss the boat. Although some of these tips sound as though they could be quite easy to do, there may be a little bit of complexity around them depending on your personal circumstances. So I would urge you, if in doubt, please seek professional advice. And remember, we're here should you need us.